Good morning. This is Ken Long from Tortoise Capital with a summary overview of the index overreaction swing trade system. This is just the highlights of the rules and some of the concepts. So, the mechanical application of this is for main indexes only. It only trades in the direction of the long-term trend. It can go short or long, depending on that market condition. It requires a significant short-term move away from the primary trend, and we're going to define significant in a precise way to capture the idea that it overreacted against the trend and that the primary trend is going to pull price back towards it. And so we're going to establish a short-term trade to capture that snap back to the primary trend. To implement this system, we've got to define some concepts. We're going to use average true range percentage in order to define a significant move. We're going to call the 200-day moving average and price with respect to it the long-term trend. So if price is above the 200, the long-term trend is bullish. If it's below the 200-day moving average, we're going to call that bearish. And then we'll use the 10-day moving average as the short-term trend. And so we're going to look for a volatile move away from the short-term trend, and then we're going to play for a snapback or an overreaction move back to the short-term trend, which will quite often overcorrect, and so that gives us more than just the short-term fair value, which is represented by the 10, but might carry over and give us a little more reward. Summary of the system, you can see it's been profitable during the back test period 94 to 2004. Made money on both sides of the markets. Relatively simple to trade, easy to learn. Can be implemented purely mechanically. It's been a consistent moneymaker on both sides of the trade. Has outperformed buy and hold over the same time periods. Has a few simple rules. Sorry about that. It only takes a few minutes a day to implement. And it's based on a statistical analysis of performance, and it uses volatility to identify prime time opportunities. And the main concept is that market corrects back to its long-term trend, back to its fair value, after a significant overreaction away from that trend occurs. That most of those are false reversals. And so, in order to buy, the first rule is that today's close is greater than the 200-day simple moving average, so we can trade on the long side in accordance with the dominant long-term trend. And we want today's high to be less than the 10-day simple moving average, so that tells us that we have pulled back or away from the main trend. Today's close is at least one ATR percentage less than the 10-day simple moving average. So what we have is a strong move that goes beyond normal volatility levels. And so we'll either buy at the close or buy tomorrow's opening. The close is preferred because there's usually a micro advantage on the long side when you do that people will recognize this aberration as a buy on dip opportunity after the market is closed, and there may very well be a stack of orders to buy at the open the next day, and that could cause market makers to raise the price in the early session. And so in order to get that pop, you might want to buy the close. In order to be fair to people who are using end of day data, they can't make that trade unless they were right there when the market was about to close and they had done the calculations to determine the overreaction was occurring. And so to be fair to those folks, the performance statistics I've given you are based on buying tomorrow's opening rather than today's close. Now you can buy another setup, buy another unit of risk in one symbol if the setup continues while you're still in the trade, and that will normally be the next day. If it hasn't had its snapback reversal. Sometimes there could be one more move away from that primary trend, and you might be underwater a little bit on the first trade, but the second setup proves to be a good trade as well. And just to note that we're using ATR percentage, ATR 14, as the measure of short-term volatility. And the exit occurs, and you exit everything, even if you get two positions, it's all out, when the close is greater than the 10-day simple moving average. So you would you would sell tomorrow's opening. Now the sell system is exactly the same, but a mirror image. So you're going short if today's close was less than the 200 and today's high was greater than the 10-day simple moving average. And then we want the close to be less than to be at least an ATR percentage greater than the 10. This should actually be the low. That's right. And then we're going to be in that trade. We will sell at the close or at tomorrow's opening, or in other words, buy back, buy to cover. If we get the closing signal. Oh, that was correct, sir. Yeah. So the entry is to sell. Can't even read my own slides. Sorry about that. So we sell at the close, or sell tomorrow's opening. Sell another unit if the conditions repeat, and then the exit is to buy to cover when yesterday's close is back on the correct side of the 10-day simple moving average, and that now the edge is gone. You don't have to monitor this all day. It can be done exclusively with close of day data. You get both sides of the market. Your cash is not tied up in a system when there's not an edge. If you can be calm trading mechanical systems, this allows you to trade in the proper direction at times when the market is already agitated because of the size of the overreaction move. The rest of the market is starting to get nervous, and if you can trade it calmly, then you can enter calmly. It has purely mechanical signals, so you don't have to use any discretion if you want to trade it purely mechanically, and has a high winning percentage, as we saw in another video. The right way to apply it is to trade a basket of ETFs, keep it simple and emotion free, just follow the rules. Paper trade it until you feel comfortable appreciating how the system trades, and then when you start, use small position sizes. Now here's an example of a setup from September 20th, 2012. We have the price was well above the 200-day moving average. You can see here, this is the 10 and the 20. The 10 is this red line, and now the signal day occurs on this day when the high is less than the 10 and the close is more than one ATR percentage away from the 10-period moving average. So the magnitude of that move is what creates an opening here. Now what's nice to see is that this first long red candle is not a setup signal because it had some of its price on the proper side of the 10. So the fact that it straddled that 10 means this cannot be a setup day. This one may have signaled. It probably was pretty close. If you had gotten this signal, you would have bought here, and you would buy another one tomorrow, because this one would this is where the signal actually occurs. But if this were a signal, this is where you'd buy your second position. So you can see already how agitated that market would be. You might think, well, this big red candle marks the limit of that up move. Historically, 70 to 80% of the time, this market corrects and goes back, and so you're buying in the direction of the long-term primary trend, and that's what that setup will always look like. You'll notice from the channeling video, this is also one that would fire on the channeling system. They quite often work together in that way. So that's what I want to say about the overreaction system. It's kind of a bread and butter system. It's in the market about 15% of the time. Unlike channeling, it allows you to go in both directions, and like channeling, very simple, can be mechanically applied, and there are ways in which you can optimize the entries on day one, on the day that you're taking your entries for the system. It's been a very reliable system for us for years, and that's the channeling. I'm sorry, the overreaction system.